In that connection, I want to read this to you. Today's Wall Street Journal, the abreast of the market column. The most marvelous newspaper you can get as a contrary indicator, because everything you are told in this will help the stock exchange and contribute to your ruin in the market. Listen to this. Everybody's buying, not just insurance companies or hedge funds. It's everybody, said Thomas Gallagher, managing director of Oppenheimer and Company. I want to ask you, when you read that, and he tells you that everybody's buying, do you for a moment pause to ask who is selling? That's the relevant question. The question you'll never see answered in the Wall Street Journal or on any financial page, because the Wall Street Journal, the New York Times, and the Los Angeles Times have as their proprietary owners the New York banks and the New York Stock Exchange. They own the press and the networks. You'll see if you read the ownership, go to the library, CD and Company, that's the nominee, listed as one of the owners. But it's the nominee of the New York Stock Exchange. They don't put the name in there, of course. They hide that with the nominee.
The tapes you're about to hear are a combination of the best parts of 2 all-day seminars held in March and October 1989.
Now you have to understand that the stock exchange's controls are everywhere. Its controls lie within controls, like the skins of an onion. You can't pick up a newspaper, turn on a radio or television set, take a course in economics or business without being bombarded by the fictions which form the basis of the public's thinking about the stock market. Now, the most important control, of course, that the exchange exerts, as many of you know, is over stock prices. And it's the control over stock prices that gives the stock exchange its greatest control over investor behavior. Most investors believe, a great many of you in Los Angeles don't because you've heard me on television, but all over the country, the belief exists that heavy demand for stock causes stock prices to go up, and heavy selling drives prices down. And most investors are also totally unaware that specialists exist. Never heard of them. And if they are aware of them, they assume that they're to maintain fair and orderly markets. So, we must begin at the beginning then. You must understand that there are approximately 350 specialists on the floor of the stock exchange. And they are divided into 55 specialist units. Now, these units handle anywhere from 10 to 80 stocks or more.
In a nutshell, there is an individual called the specialist who, at the same time he's allowed to invest for himself, is given the incredibly sensitive task of setting the price for the stocks that are assigned to him. This individual, the specialist, becomes a merchant. As a merchant, once he has inventory, his incentive becomes to sell that inventory at a profit. And so he will use his control over price to rally the issue. When he gets to a predetermined level, he will sell his stock. He'll distribute it. And then his warehouse is empty. His investment account or his trading account may have no inventory in it. When he wants to reacquire stock, of course he wants to do so at a lower price. And so he'll begin to drop the price after he's sold out his account. But the specialist never misses a chance to make a profit anywhere in this cycle. And so just as he made a profit accumulating and then distributing at a higher price, the specialist will sell short so that he can profit in the down part of the cycle.
Now, when you place an order to buy or sell stock, it goes from your broker to the specialist who executes it on your behalf. Now, when there is an order imbalance, he's supposed to supply that imbalance either by absorbing the stock or supplying that stock from his own account. Now, that would be fine if that was all there was. But what is in reality, in existence, is that he is in there trading for himself, for his own investment and trading account, actually in competition with you, with the public. And this wouldn't be so bad either if it wasn't that he didn't totally control the movement of stock prices. Now that's hard to believe. And so what I want to do is actually to document that kind of statement very quickly by just taking a couple of pages, a couple of sentences out of the special study report of 1963, which, in conjunction with Ferdinand Pecora's investigation of the stock exchange in 1933, is quite possibly the most important document, special study report of 63, that was ever produced about the stock market and the New York Stock Exchange. You had, I should point out to you, on that staff study, individuals from the SEC who were there, without any question, to whitewash as much of this report as they possibly could on behalf of the stock exchange. One of them actually, when this was completed, left the SEC and soon afterwards became president of the American Stock Exchange, in my opinion, because of what he did for the stock exchange in the course of this investigation. The SEC has been a captive of the stock exchange since its inception in 1934. I should tell you quickly, too, that despite the fact that the SEC was ordered by Congress to investigate the stock exchange, the SEC shaped its report on the report given to it by the New York Stock Exchange about what's supposed to have happened in the course of the crash of 1962. And they confined it to just 3 days in May 1962, the last 3 days, instead of, as you'll learn later, on the basis of what actually happened beginning in 1961, where the crash was set up for 1962. So that despite the fact that the evidence that the SEC's staff study group was allowed to work on, you had a formidable revelation. For example, and it's part 2, volume 2 of this report you should get from the library, UCLA library, the main library downtown. Page 142, it is evident specialists have the power to set and control prices unilaterally. The Los Angeles Times and the New York Times have never published that. They focused on other things about the SEC report, about mutual funds, about commissions. They left off everything that was important on behalf of their wealthiest advertisers. Well, when the SEC staff report came out and the New York Times and the Los Angeles Times said nothing about what was relevant to that study in terms of the specialist, I prepared my testimony, sent 7 copies off to the House Banking and Currency Committee, and was invited then to come and speak before the committee. I flew to Washington, and when I got there had been stories out that an ex-actor was going to appear before the committee, and the room was filled. And I waited for my turn. Everyone was very gracious to the people who were speaking there that day. When I came to talk, led by Senator Jacob Javits, all the senators marched out. They'd read my testimony. They didn't want to hear me. They'd read everyone else's testimony. They listened to them, but they didn't want to hear me. Willis Robertson, who was the chairman, had to stay there. He retired later and became a lobbyist for the bankers, which he was when he was in Congress. Now, he told me, look, Mr. Ney, you don't have to read that. Submit it for the record. We all know what's in it. I said, Senator, I said, if you wanted me to submit it for the record, you should have called me in California. I've traveled 3,000 miles to read it. I'm going to read it. He protested, but I began to read. There was a little murmur of applause. They wanted to hear me. That's what they'd come for. And all during my testimony, you'd say, would you please hurry up? Would you please hurry up? This never happened before to anyone testifying before a committee. When I finished, he stalked off, and there was tremendous applause. The reporters from the Wall Street Journal, the New York Times, other papers came up and interviewed me. They congratulated me. They were ebullient. The following day, I was dismissed by the New York Times, and the Wall Street Journal had the bad taste to insult me and to finish its comment by saying, it is unlikely Richard Ney will ever affect the course of securities legislation. That was probably the biggest mistake the Wall Street Journal ever made on behalf of the New York Stock Exchange. Because I was determined to prove them wrong. They were right, but fortunately I didn't know that. I thought I could prove them wrong.
We have a system in which the Federal Reserve System works very closely in harmony with whatever the stock exchange is doing. And as I've been telling you on these broadcasts and in my forecasts for many years, whenever the stock exchange is taking prices to a high and they want the public to charge into the market, they make money market instruments very unattractive by dropping interest rates, and they synchronize that always with an advance in stock prices, so that the public says, why should I stay in these money market funds when I can make all this money in the market? And they go into the market at precisely the wrong time. I want to read you what I said in the forecast for 1990. Quote, the stock exchange is the puppet master pulling the strings that control the Fed. When specialists and other exchange insiders want to accumulate stock, they raise rates in order to persuade investors to sell their stock at a market low. When stock exchange insiders want to sell their big blocks of stock, rates are dropped dramatically as the Dow average is advanced sharply. This makes it easier for the exchange to pull investors out of low-yielding cash instruments into the market. It's like taking candy from a baby. People are wondering and saying, why is the market going up? And they're being told by everybody that it's because the market is anticipating a recovery in the economy. The market has nothing to do with the economy. The market's going up now so specialists can get you to buy, and so they can sell and sell short and then drop prices. And that's what the market is composed of. As you know by now, I'm sure, it's a merchandising operation, purely and simply. The whole purpose of a rally is to enable them to distribute and sell short, so they can then conduct a decline. This morning I want to read to you something by a man who expresses himself like the common man, but who writes like the wise man. Talking about Gore Vidal. And this is a group of his essays, At Home. It's called At Home. And they were written, these essays, between 1982 and 1988. And he says, to understand Nixon's career, you would have to understand the United States in the 20th century. And that is something that our educational, political, and media establishments are not about to help us to do. After all, no myth, no nation. They have a vested interest in maintaining our ignorance. And I think I might add that far more crucial than what we know or don't know is what they don't want us to know. That's just my own little aside. And that is why we are currently stuck with the peculiar notion that Nixon just happened to be the one bad apple in a splendid barrel. But the national myth requires periodically a scapegoat. Hence, Nixon's turn in the barrel. By keeping the Dow up in what was record territory, specialists were able to unload and sell short tremendous additional quantities of stock. And I think you should also realize that what you are watching is a phenomenon that has nothing to do with earnings or an auction market. Here you had General Motors up on the very day reports were coming out about its sales being worse than any time during the past 10 years. And it unloaded 4 million shares of stock. The whole purpose of rally is to enable them to distribute and sell short so they can then conduct a decline.
The same specialists who operate on the floor of the New York Stock Exchange have specialist units on the American Stock Exchange, doing the same thing on the American they do on the New York. Very briefly, an excerpt from the conclusion of the report of the Special Studies of Securities Markets. Specialists are at the heart of the problems of organization, management, and disciplinary procedures of the exchange. The misuse of their fundamental role in the operation of a fair and orderly market and the breakdown of regulatory and disciplinary controls over them all are part of a complex pattern of interlocking causes and effects. It's for this reason that any program of reform must concentrate heavily on the dominant role of the specialist. Now, this is absolutely incredible. Here we have the documented evidence of fraud, of a situation in existence which would make the devil envious of what goes on the floor of the stock exchange. And incidentally, I believe, raised as a Catholic, I believe if there are any devils in this country, they're on the floor of the stock exchange. No question about that. Now, you have to understand then that what you're talking about here is not an auction market. It has nothing to do with an auction market. You're talking about, really, a vast sales organization in which specialists act as merchants, pure and simple.
I also want to make a remark about something that somebody asked in a previous seminar, which was how the specialist could possibly have the financing to accumulate all this for himself. The answer is he doesn't. He doesn't need to accumulate all these blocks for himself. One of his main functions on the stock exchange is to act as a gatekeeper, as a door to exchange insiders who are other officials on the stock exchange, officials at investment banking firms, at large brokerage firms, some of the corporate officials at the major companies listed on the stock exchange. In addition to doing the buying and selling for his own account, the specialist is obligated for these individuals at major highs and major lows to get these people into and out of the market. And that's why you'll almost always see at a major bottom and at a major top a period of time go by before the specialist makes the important move.
They have to have a system organized so that the whole thing works like an enormous phalanx of juggernauts. They all move together, these big, big, big juggernauts, Exxon, Telephone, General Motors. They're all obliged to cooperate and work synchronously. That's why the Dow average, you can draw a point to the Dow average because they all work so carefully together that the Dow doesn't move any differently than the group. They're all so tightly controlled that that moves just like a stock. The other thing is they have so much money now. They can get that much more stock, so they want to accumulate that much longer. And you must understand too, contrary to everything you've heard about their capital requirements, they have unlimited resources from the Federal Reserve System. In the first book, William McChesney Martin, the chairman of the Fed, is a member of my club in New York. When I wrote to him asking him the information on specialists, can they get credit from the Fed, he wrote back, yes, they can get emergency credit. I published that in the book. He never thought I'd do that. Now I want to get on to the media and show you that, like the Dow average, to a much lesser degree, but very important, because it's the propaganda arm of the stock exchange. It's just like the Wall Street Journal is no different than Izvestia. And I must tell you, but the only place that capitalism is practiced is among the middle class. That's where the only place where the competition goes. It's socialism at the top. And the taxpayers pay for it, pay the banks, pay whatever firms need the money, we'll finance it. But it's socialism for the very wealthy, the heads of the corporations, and it's capitalism down in the middle. We are the ones who compete with each other. There's no competition up here. If they lose, they go bankrupt, they're financed by the government. Lockheed, Boeing, doesn't matter what happens, they're going to be kept in business. If it's necessary to pay $600 for a toilet seat to keep them in business, we'll pay $600. And that's the point. It doesn't matter that it's $600 for something absurd. The point is not what you're buying. It's the fact that the whole function of government is to give them that money, to get it in there, and to have the support of that corporation when you're going for re-election. What I'm going to discuss now is, as I say, the media, to show how it's a very important arm of the stock exchange. And you'll get stories coming out all the time to rationalize the frauds of the stock exchange. I have no hesitancy in saying it. Now, the role the media plays in this vast organization of stock price movements is extremely important and extremely devious. Daily financial publications like the Wall Street Journal, Barron's, and the business sections of newspapers get most of their information from the wire services like Associated Press, Reuters, the Dow Jones Wire Service, and so on, who in turn get their information directly from the New York Stock Exchange News Bureau. In other words, the stock exchange feeds to the public the news and the opinions of so-called experts that it wants the public to hear. And the news and opinions it wants the public to hear are always geared to persuading the public to react in a way that will be most profitable to specialists and other stock exchange insiders. And equally important, by supplying the public with reasons, which we call alibis, for stock price movements, attention is always directed completely away from the specialists. Everything that comes from the stock exchanges directs attention away from the market's real movers and shakers. So you should realize that at market highs, what you read in the Wall Street Journal will tend to keep you in the market, and that what you read at market lows will make you feel like giving up and selling right at the lows. It's when you put a lot of men together in a group that their conscience evaporates. They have no feeling about committing the worst crimes against their fellow man if other people are doing it at the same time. If there's a whole group of their buddies doing it at the same time, they'll all do it. And that's the nature of the system. And that, by the way, was pointed out by James Madison when he was forming the Constitution. He said you have to be careful of letting a group of men get together to determine policy, because they become unscrupulous when they become a group. They lose their conscience. Roosevelt was financed by specialists and other members of the stock exchange for his election against Hoover. They turned from Hoover when Hoover ordered the Senate investigation of 1932. To punish him, they put Roosevelt into office, and he was put into office by their financing. And they tried to make the laws so that the many could not tyrannize the few, and the few could not tyrannize the many. But we have a situation existing now where we do have tyranny by the few over the many. And the whole system of our country is geared to serving the interests of the wealthy Wall Street financial establishment.